Can you hear me? Can you see me? Wonderful. Yes. Yes. Understood. Thank you, Monsieur Toussaint, for that introduction. And thank you to the Bank of International Settlements Irving Fisher Committee for the opportunity to speak with everyone here today from around the world. And thank you to the Bank of Italy for hosting such a wonderful workshop. Mille grazie, molto piacere di conoscerla. There we go. So, again, good evening, good morning, and good afternoon from Ballarat. And before I start, as we do here in Australia, I begin today by acknowledging the traditional custodians of the land I'm presenting from today, the Wadawurrung and Djadjawurrung people, and pay my respects to their elders, past, present, and future. I'd like to start by thanking Emmanuel Blonkowski. He's our chief data scientist here at Quant Property Solutions for his work on the paper, as well as Sandy O'Reilly for her editing skills, as well as Josh and Francesca for their feedback and suggestions regarding this presentation. So, who are we, what do we do, and how can we help? My name, as I said, is James Nicol. I'm the director of Quant Property Solutions Australia. We're private enterprise. We're industry. We're a RegTech-focused SaaS developer, and we specialize in creating new and innovative micro-prudential tools for central, national, and reserve banks, as well as prudential and supervisory authorities. The paper submitted to the IFC and my presentation today is focused on a solution for a very specific micro-prudential challenge. Next slide, please. What are the impairment costs of traditional non-quantitative retail banking practices during residential real estate foreclosure sales? And what is their effect on central banking policy? And how could the use of supervised machine learning applications during micro-prudential processes within the product lifecycle of residential mortgages lessen that impairment? So why is this important? Since the GFC, globally, many countries' prudential supervisors of their retail banking sectors have mandated increased supervisory measures to ensure responsible lending standards, as well as amplify consumer protection advocacy to defend against improper lending practices and improved market stability within their retail banking sectors. After all, residential real estate is the world's most commonly transacted financial asset. And while the retail lender's requirements for mortgage loan approval and servicing are backed by quantified, standardized regulatory processes and approved prudential procedures, we observed quantitative gaps in processes within the product lifecycle of residential mortgages, specifically when non-performance necessitates involuntary liquidation and a foreclosure sale. Next slide, please. We reviewed and compared working papers, policy statements, guides, and guidelines for retail residential mortgage underwriting and lending standards from several sovereign prudential authorities as well as international supervisory bodies, and had difficulty finding quantitative standards and guidance or guidelines for retail banks on their selection processes when choosing the real estate agent, the estate agent, the broker, the mechanism for involuntary liquidation should non-performance of the mortgage necessitate a foreclosure sale. We asked the question, firstly, does this quantitative absence in guidance cause an impairment to prices during the residential real estate foreclosure sale process, and how do we confirm that? Second, how do we identify that the cause of impairment is qualitative in origin? And is there correlation in the lack of quantitative processes within a residential mortgage product lifecycle to the causation of impaired prices? So we wrote a bit of code, and that could solve those two specific challenges. Serendipitously, by solving those two problems, as a byproduct, the software indexing system we developed also became a forecasting tool. By developing a proprietary index to contextualize the real estate agent, the estate agent, the broker's historical econometrics, it became an indication on whether the bank's choice of selling agent was going to deliver sales results above or below their market average to a high degree of accuracy. Next slide, please. Our first empirical use case started with a random sample group of 500 Australian mortgagee residential real estate sales transacted between June 2018 and March 2020. Next slide. Of the 500 properties, the indexing revealed that just under 77%, 76.8% of the properties sold sold below the market's average sale price of similar properties with similar hedonic attributes within 1,000 square meters of that property. Next slide, please. The average difference between the foreclosure sales result and their market's average sale price per the sample group was $46,607 in the negative. So comparatively to a market's arithmetic mean, within our random sample group, again, of 500 foreclosed residential real estate properties from across Australia, over 3/4 of the foreclosed bank properties sold for under their market's average sale price. Now that's significant. That's a significant number. When benchmarking the performance of the bank selected agent, we were able to index other market participants who would have been a more ideal or best agent to ensure transactional optimization of the foreclosed property. Next slide. The gap between the bank selected sales agent price result and the best agent average sale price result is even more significant. The average difference in the sample group was over $150,000. As a forecasting tool of the 500 properties sold, our indexing / forecasting tool had a 94.3% accuracy in predicting the foreclosure sale price outcome and having sold either above or below the market average. We became very excited at that point. Next slide, please. We repeated the process to markets outside of Australia to see if what we discovered here had utility globally. So we went to and looked at, included bank-owned mortgage default, repossessed, and foreclosed real estate sales in Canada, England, France, Germany, Ireland, Spain, and the United States of America. Extrapolating the original number of our sample group of 500 foreclosure sales by population size comparative to Australia. The biggest challenge was in securing multiple residential real estate data suppliers to ensure data set veracity. Ideally, each country had to have a minimum of 3 data suppliers. The regression algorithm used to index the market participants operates within a very narrow band of temporal and spatial scales nominated by the user. Next slide, please. The best fit, a binomial distribution model, allowed us to figure the probability of observing a specific number of best outcomes when the process was repeated against the selling agent, with the outcome for a given selling agent is either success or failure. A benchmark result against the market's average and other market participants. Per the slide, N denotes the number of observations or agent performance econometrics. Some of those econometrics are days on market, list price to sale price differential, dollar per square meter, or per square foot, I should say. And the X denotes the number of successes or events of interest occurring during N observations. The probability of success or occurrence of the outcome of interest is indicated by a P. The model allows for the proprietary indexing of market participants geospatially on a property by property basis. In use and function as a microprudential tool, the software utilizes supervised machine learning attributes, identifying and isolating outlier results, dimensionally reducing and classifying input variables with each software update. Next slide, please. As a solution to quantitatively improve upon legacy qualitative retail banking practices during the involuntary liquidation of residential real estate, the Best Agent Index ensures greater risk transparency to facilitate better data-driven decisions when retail banks select selling agents during an involuntary liquidation event as a microprudential tool. So why does this solution matter? Next slide, please. In healthy developed residential real estate markets prior to 2007, foreclosure sales and non-performing home loans annually represented less than 2% of their respective markets. And while it is difficult to disentangle the triggers of a downturn event from its amplifiers, default, foreclosure, and repossession sales of residential real estate were amplifier events of the global financial crisis. The challenge now is setting quantitative standards within qualitative principle-based frameworks to improve outcomes and reduce the gap between involuntary liquidation value versus market value. Current frameworks contain flexibility for individual jurisdictions to adopt their own standards according to their own circumstances, as real estate markets are dynamic and underlying risk differs greatly across jurisdictions and within countries. The problem that we've solved for central banks isn't a problem for central banks until it is. The use of supervised machine learning software would aid in effective collateral management during involuntary liquidation, especially during mass mortgage default events, by lowering the threshold of action triggered by current frameworks, and would advance consumer protection by identifying market participants that outperform their market's average. The difference in people terms, tens of thousands of dollars, pounds, and euros, and unrealized funds for the defaulted mortgager's repayment capacity to creditors. Next slide, please. Exponentially, again, using Australia as a point of reference, the gain of hundreds of thousands quarterly in unrealized taxes and stamp duty at a state level from the causal inference of impaired correlated sales. In our abstract, we mentioned how, as prudential supervisors, introducing new quantitative machine learning analytical applications can be a huge challenge due to the different interests of various stakeholders and the large capital investment in legacy processes, procedures, and systems by the retail banking sectors. To overcome this challenge, there's an opportunity for collaboration and communication between private and public entities. Innovation labs and hubs across prudential and financial supervisory authorities, as well as central, national, and reserve banks, are the safest, most cost-effective way to pool resources, to engage with new technical offerings, to run empirical testing of new analytical software parallel to the established qualitative processes, procedures, and practices currently used within the retail banking sectors. This would allow for the methodical testing, vetting, and validating of new quantitative software prior to investment at scale, to ensure that data-based service decisions are for the macro and micro prudential benefit of all invested parties. Thank you so very much. That's my time. Yep, questions after, yes. Yep. Yeah, I'll just turn off the camera. Thank you. Yep, I'm here. Okay, question? All right. Okay, I'll repeat the question. Thank you. Okay, question was, are we experiencing a worldwide property bubble? Well, if there is a property bubble here in Australia anyway, it's been a 20-year bubble. So, I am no economist, but I'm sure there are more than a few world-class economists watching the stream who would answer this. I know just enough to be dangerous, but in the in the efficient market hypothesis, you can't have an asset bubble because markets are efficient. What I've said in the paper and this presentation is the use of supervised machine learning applications during microprudential processes within the product lifecycle of residential mortgages would lessen that impairment. So it's the market participant efficiencies that need improvement. Because, again, 2% of the banks don't make up the market makes the market. You know, does the tail wag the dog or does the dog wag the tail? If that makes sense. Next question? Okay. Question. How many data sets does your software use to evaluate price of the foreclosed property? Well, we don't use any data sets to evaluate the property. Our software evaluates the real estate agent, the estate agent, the broker selling the property. So our software relies on a number of non-traditional data sets, very granular, disassociated operational data that needs to be aggregated and verified sometimes from several data sources and data sets. When, we then correlate those data sets to evaluate the real estate agent, the estate agent, or the broker on a property-by-property basis to measure their performance and results for accurate insights. We turn hidden data into prescriptive action across the complete mortgage product lifecycle as it pertains to involuntary liquidation of residential real estate. Okay. There's another question let me just scroll up here. in the chat. How long have you been working on the software, and what challenges did earlier versions have? I've been working on the best agent index in one form or another for almost 6 years. It's a problem that hadn't really been solved before with software, but since the creation of the SDMX standard and increased usability of data analytic platforms, and there are people who, I prefer the syntax and the flexibility that R offers as opposed to Python and Jupyter. I think that what it allows for is that loss given default doesn't have to be the norm anymore when it comes to foreclosure sales. Early versions resembled a Markov chain, and we played around with a Bernoulli model, but we felt that the binomial distribution model was our best fit. Is another question? How does your software handle missing data? There's a lot to unpack there. Low quality missing data, it keeps me up at night. And Manny, our chief data scientist, Manu. That's why the more data suppliers, the better to fill in the blanks. But then we had to write a program to verify what was going into those blanks. For an analytics platform, your outputs are only as good as your inputs. Garbage in, garbage out. That's why we train, test, and validate every data supplier. Question was, do I think residential real estate volumes affect pricing, not just the worst real estate brokers? Most definitely. Economics 101 is that scarcity creates value. When it comes to the worst brokers pertaining to volumes of residential real estate for sale affecting price, I think banks need to acknowledge that selling for selling's sake to release the equity can have a negative pricing effect. During the GFC, I heard people referring to residential real estate as a toxic asset. 12 years later, retail banks are running at breakneck speeds to get back into housing. Lloyd's Banking Group wants to become landlord to 50,000 homes by the end of the 2020s. Blackstone recently acquired Home Partners of America in June to become one of the largest landlords in the States with 17,000 rent-to-own properties. Residential rent rolls are cash flow positive, and I think you're going to see a lot more banks developing internal residential leasing structures and strategies to manage bank-owned residential real estate assets in the near future globally so that they can. An empty house is a lazy asset. So I think what they're going to do is, rather than selling for the sake of selling, they're going to hold on to that asset and rather than realizing a loss. Are there any other questions? All right, thank you. If anyone has any other questions or would like a demonstration of how our software works, please do email or call. My information is on the Bank of International Settlements Irving Fisher Committee Bank of Italy workshop website. Good night, good evening, and good morning from Australia.